Good morning and welcome to the Killik & Co market update. Markets still remain at very high levels despite the fact that impacts of the coronavirus are starting to become more apparent across the economy. It's not so much the direct impacts of the virus itself, it's more the impacts of the reactions to it. Travel routes have been closed down, factories have been closed, shops have been closed across China, and people are staying in rather than going out shopping and spending money. And we are starting to see the impacts of this across the economy. Over the last week, we have seen a number of companies announcing that profits or revenues for this quarter are likely to be lower than previously expected because of the reduction in economic activity across the region. Burberry, for example, has announced that because so many stores have been closed, their profits are likely to be below expectations. RELX, which is a major publisher and manager of exhibitions, has announced it will probably suffer because a number of exhibitions have had to be cancelled. And perhaps more importantly, Apple, largest company on the stock exchange, has this week announced that revenues are likely to be below expectations because of the impacts of the coronavirus. Here we have a couple of quotes from the announcement that Apple came out with this week. So they said there are two reasons why their revenues are likely to be below expectations. The first is that worldwide iPhone supply will be temporarily constrained. While our iPhone manufacturing partner sites are located outside of the Hubei province, and while all of these facilities have reopened, they are ramping up more slowly than we had anticipated. The second is that demand for our products within China has been affected. All of our stores in China and many of our partner stores have been closed. Additionally, stores that are open have been operating at reduced hours and with very low customer traffic. So I think this really gives a clear picture of what's happening within China at the moment. And I think with so many brands and companies experiencing similar types of slowdown here, I don't think anyone is really expecting growth numbers for the economy for the first quarter to be particularly strong. And with that in mind, I think it is a little surprising that markets remain at such high levels, given that there are these levels of concern. And also this week, we've had an announcement from HSBC saying they're going to embark on a major restructuring program, and they will be cutting 15% of their global workforce. That's 35,000 individual people. So this is a fairly major restructuring for HSBC. HSBC for quite some time has been known to have a fairly high cost base, and therefore it's not altogether too surprising that they are trying to reduce this cost base in order to raise their level of profit. HSBC, in comparison to other banks, does have a very high reliance on Asia. If you have a look at this chart here, you can see the countries which HSBC is reliant on for revenues, and you can see that Asia is by far the most important region, accounting for 48.8% of HSBC's revenues. And if we were to look at profits, that number would be even higher. Now, historically, due to the higher growth rates within Asia, this dependence on the region has been a positive for HSBC. However, over the last few months, I think it's fair to say it's been more of a drag. Starting off with the protests across the Hong Kong region, that had a real slowdown effect on the Hong Kong property market, and that's a very important market for HSBC. And then we've moved on into the coronavirus. That's caused a real slowdown in economic activity across Asia, and no doubt that's also been quite worrying news for HSBC. So with that in mind, not altogether surprising that HSBC is embarking upon this restructuring program. Now, when this announcement came out, HSBC shares reacted quite negatively, down 6%, and it is fair to say that this is a company we are watching quite closely at the moment. And finally, this week, we've had some positive news regarding the UK economy. It has been reported that UK house prices were up 2.2% in December. It's been a fairly stagnant few years for the UK housing market, following on from the concerns about Brexit and the UK election. So it was very much hoped that following the election, we would start to see a bit of a pickup in activity. And so far, it does seem that that is becoming to be the case. Now, perhaps more important than price is the pickup in volume. If you have a look at this chart here, you can see the number of housing transactions going through in the UK every year since the year 2005. So as you can see, there was a real drop-off around the time of the financial crisis. Following that, we had a fairly steady rise, and then we've had a fairly stagnant period from 2016 onwards. So it really is hope that now we've got more clarity, we'll start to see more of a pickup in those housing volumes. But on the face of it, this data does seem to be positive for the UK. Moving on to the week ahead, fairly busy in terms of corporate reporting. We've got results out from Rio Tinto, the commodities company, chemicals giant BASF, and also the French energy consultancy ENGIE. That's it from us. Have a great weekend, and we'll see you next Friday.